Welcome to the Trader's Desk. It's the 2nd of March. Believe it or not, we're already in March. Um Today we'll look at the macro backdrop and look at the price action analysis. It's been quite an interesting week where the markets have basically just sold off, and then in the last hour on Friday, somehow we kind of got a little bit of bullish action. So we'll dissect into that and see what we make of that. I was also looking at some stats when it comes to auto loans. So I've got some interesting charts. I think it would be quite interesting for the group to have a look at these. And then if we have some time, we'll break off for some Q&A. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer. And all the materials presented here are owned by the Financial Traders Hub. So do read this copyright notice. Let's start off with the RSP. So this is the equal weighted S version of the S&P 500. So as you can see, it's been a bit of sideways action in the last few weeks. So that's not a shocking or surprising stat for us. The S&P itself is down a lot more. So that's quite interesting. It's quite evident that a lot of the downwards action is coming from the Magnificent Seven, which I've got on the right. So you would remember maybe a week or two ago, we were speaking about the Magnificent Seven and that these have a real potential for breaking down from where they were trading. I think at the time it was maybe 54. And in the last 2 weeks, we've had quite a sharp sell-off in the Magnificent Seven. So, um, like I mentioned on Friday, there was a little bit of resurgence in the market and, people feeling bullish. So it's always a question of whether this is like real bulls buying or whether this is maybe profit taking as we're going into the weekend, right? So that's what we need to figure out. Um, Quite interestingly, I've got this chart on the left which denotes it's an ETF of momentum driven stocks. So that's just to give us an idea of how these momentum plays have been doing. If you look at it, it's been trending upwards for the last few months, right? So quite a bullish action, and I think we've seen it in individual stocks as well, right? Momentum driven names have just been flying. Um, in the last 2 weeks, we've had a bit of a hold, and you can see this in this index as well. So I just put it there for us to get a little bit of perspective in terms of what's happening. There's a lot of noise, there's a lot of stories out there in the market, but we always have to drill down and, reset ourselves and get perspective on what's happening and where we are in this whole bull market. We're still in a bull market, right? We're not falling like it's not a free fall by any means, right? Even if you might see quite a significant downwards volatility, we're still in a bull market, and that's something that happens, right? It's part of a correction. So I still think that these momentum driven names have a lot more downside, and there's a potential for it to pull back further. So keep a look out if you've got a portfolio that's a bit too heavy on momentum driven names. Um, just be a bit careful there because volatility will just as VIX creeps up, I think this will just create a lot of issues for these momentum driven plays. On the right, I've got the crude oil price. So as we've seen, this has been trading within a very tight range in the last few months. And I think a lot of it has to do with the uncertainty on the geopolitical front. And at the same time, the global GDP or global manufacturing activity also not necessarily growing that much. So this oil price is reflecting a lot of things that are happening in the Middle East with Iran, with Israel, but at the same time, also reflecting potential possibilities of the Russian-Ukrainian conflict being resolved or not being resolved, right? We saw a lot of drama on Friday with Trump and Zelensky meeting face to face in the Oval Office. Uh, to, it's not an understatement to say, it's probably an understatement to say that that meeting was one for the history books, did not end well at all. So we have to think about what does that really mean? Is it a situation where now the Russian and Ukrainian conflict will be prolonged? If that's the case, what does it mean for us? Probably not much at the moment because everything has been going on for a number of years, and even as we got the Trump election and all of this, it's not that the markets have changed in a different or drastic manner to reflect any potential resolution of the Ukrainian or and Russian conflicts. Um, this is something to keep in mind because it's an important pop piece of the geopolitical landscape, and any escalation in these conflicts can really cause a big difference to the world order. Um, I think all the world leaders now will think twice when invited by Donald Trump, especially if there's a live press conference involved. So a lot of the guys who don't have English as their first language would probably um, want to bring around their translators just to, diffuse and waste time because these press conferences are not going well at all. I think we've seen the same with Macron, with the guy who's the Prime Minister of the UK, and also now with Zelensky, which was just like craziness on steroids. So that's a little bit, uh, concerning when it comes to the way the US is leading diplomatically. Uh, I think they are taking diplomacy into a different dimension where they dictate everything, and there's no like, you know, uh, beating around the bush. We want you to do this, so you do this. Otherwise, we don't want to talk to you. I think that's the nature of the leadership in the US now, for good or for bad, who knows. But for us as traders, we need to be very careful of this, also understanding of these new paradigm shifts. So one interesting thing would be when, if ever China is invited to visit the White House, I don't really know how this will go, if they will even accept the invitation. Um, that's a very interesting situation that will unfold. Anyway, back to financial markets. So we saw the US 10-year yield head down. Um, Quite an interesting move as we've been seeing the US 10-year, sticking higher for longer. So this week we also had a few readings on inflation, mainly with CPI and PCE. So CPI indicated that inflation is on the rise, while PCE showed month on month or year over year decrease in inflation. So a little bit of a contrasting picture there. I think a large part of it has to do with the component around housing, the cost of housing or owners, equivalent rent or whatever they call it. So that's a big portion of the inflation component, and it's quite interesting how both of these reports look at this. So if we wanted to get a maybe a bit of a more real-time update on that particular component, which is basically labeled as shelter, we could look at real-time indices that give you an indication of rental prices in the US and make up our own minds. So my whole reading on the situation is we are seeing a little bit of growth slowdown pricing, and that's being seen also in the US 10-year yield. Um, my view is also that the US 10-year coming down is not probably uh, a message that inflation has been solved. If anything, this is a way for the market to tell us that the expectations of growth in the future has been significantly reviewed downwards. I think what could also be happening is we might be having a rotation of capital from equities into bonds. So that typically happens when there is a risk off move in equities or in the financial markets, and risk assets are no longer preferred, but rather people seek the security of treasury bonds, right? So a lot of things happening under the hood. There's also, the constant talk of tariffs, constant talk of, the head of the Treasury who's also looking at the US 10-year yield and who wants to see it lower. So there's all of this happening at the same time. There's also the Fed that's also, hinting that they are not going to cut anytime soon until they see meaningful progress in inflation. So with the PCE coming in at 2.6% this month, I don't know if the Fed will think this is, enough progress from their perspective and lead the market to believe that they are not now going to start cutting. I don't really know how the Fed will look at this. I still think there's an issue with inflation. And if I look at the leading indicators of inflation, I think we're headed to, you know, a period of higher inflation. But, if growth also comes down, then that's going to put a lot of pressure on inflation too. But yeah, we'll see. There's also oil that's also in the balance. So if the oil price goes up significantly, maybe there's a flaring up of tensions or supply issues that are happening. We might definitely have the oil price go up, which will be inflationary in nature. So on the right, what I've got here is basically the Fed funds rate, and this is the Fed's futures rate for December 2025. So basically, what this is telling us is that the market expects that by December 2025, interest rates will be at around 3.7%. So that kind of makes us believe that or the market is expecting a few cuts from here between now and December. So this is an index that you can keep looking at if as the data is coming through, we will see what the market is pricing in terms of their own estimates of how many cuts they are expecting between now and December, because markets will move on this expectation. So always good to be uh, to have this in hand and to have a look at what the market is pricing. So as you can see, this has been ranging quite wildly, right? And it's almost like if you look at the sideways action, it's probably three cycles in total, right? Between 2020, let's say mid of 2022 and now. And every time the market has got it wrong when it's been expecting a lot of cuts from the Fed. So we'll see whether this time it's different. My personal view is if the Fed starts cutting anytime soon, that's a reflection that the economy is slowing down much quicker than we expect. So that's probably bearish for a lot of equities. Yeah. But don't take these statements as absolutes. As and when it happens, we have to evaluate it and understand exactly what what's happening and what's the reason for the Fed cutting. Uh, Another one that we've been looking at for quite some time, so the USD um, versus the Japanese yen. Sorry. Yeah. So USD versus Japanese yen. Um, we've had inflation numbers from Japan as well. I think they came out on Friday morning. So they were not as bad as was expected. And this currency pair managed to rally a little bit. But looking at the technical picture here, I think there's more room for downside. And we all know the reason why we're looking at this, right? So if the USD weakens further versus the Japanese yen, I think there's going to be a prolonged unwind in the tech sector. We've seen that work out relatively well in the last few weeks. And I still believe that this correlation hasn't been broken and that we will see further sell-offs in tech if this index goes further lower, if this currency pair goes further lower. So we also had the GDP report that came out this week. I wanted to just show you what the GDP report is made up of. So there are five main components. Maybe some of you know already, but I just wanted to show it to you and give you an indication of what drives GDP. So as you can see, so the real GDP number came in at 2.3%, right? And consumer spending was one of the biggest drivers there. So that was probably between maybe 2.6, 2.7. And then there's investment. So that was down, which is quite interesting to see. And also we had investment from government, so government expenditures, you can put it that way. It's a small contribution to the GDP growth. And then combined with these three other components, you've got imports and exports. So we've seen an increase in imports in Q4, and I think some parts of it could be that people are afraid of tariffs and they are pulling forward a lot of the imports just to make sure they protect themselves in terms of tariffs in the future. So I think we have to understand that, people behave in different manners, and we've seen this in COVID as well, where they pull forward demand. So that can be something that becomes a theme later on when we start seeing a meaningful slowdown in imports or even the rest of the global economy not doing that well because maybe the US is not importing a lot. Um, this is an interesting one. So we've got the Atlanta Fed GDP now estimate. So this is a little bit of a moving indicator, if I can put it this way. So this was released on the 28th of February, and you see the next update will be on March 3rd, which is on Monday. So as and when important economic reports come, then this number or this estimate is reviewed upwards or downwards. So um, the reason I mentioned that the market seems to be pricing in a lower growth rate for GDP is also backed by this graph here. So the estimate for Q1 2025 GDP came in at minus 1.5, which is a first in a long, long time, right? So it's been a long time since we've seen the Atlanta Fed GDP now estimate go this low. And I'm not saying, we're headed to a recession or take this as the holy grail because this is a moving indicator. On Monday, it's, it's possible that with the ISM report, this gets revised upwards or downwards. So keep an eye on this because the market is looking at this and, making sure that they are always staying ahead of the game. Another thing that I have on the right is the components that make up this GDP now real GDP growth estimate. So as you can see, the net exports was lower, and that was I think that shows the increase in imports that we've seen relative to other quarters. So um, I think it's not quarters; it's actually relative to other years. So at the moment, this is not decisive in itself. It's not really predictive per se, but it's something that the market looks at. I think I'll be more focused on ISM and all of these others, but I'll also want to keep an eye on this because this is going to become the talking, um, the talk of the town. Sorry, for the next few weeks. As I mentioned, I was looking at some stats from the auto loan sector. So, as we all know, the delinquency rates have been quite bad or increasing quite badly in the auto sector. And it's not a surprise that a lot of the newer originations are happening within the highest credit scores. And if you see the other segments, which are subprime, near prime, prime, and prime plus, they're barely seeing any increases in originations. So I think there are more slides in later on that shows that affordability and what's the word? Affordability and accessibility of debt, especially for auto loans for lower credit scores, is getting very, very low. And with that, it's gonna put a lot of pressure on these used car segments because typically, who's gonna go buy a 10, $15,000 used car or even lower than this? It's probably not going to be people with very good high credit scores. They're going to be probably buying at a higher price point. So this is important to understand, right? Because let's say we're looking at a company like, let's say, CarMax or CarMart, and we know that they have a high exposure to that segment, then we already know what could be happening in the next quarter as they report earnings. Um, Another interesting graph that I saw here was that the average loan to value ratio for used cars is consistently above 100. So, people who have maybe taken a mortgage before would know about the loan to value ratio, right? So typically, the bank will want you to have a low loan to value ratio because that's an indication that the bank is not overly leveraged to your property or to you as a loan. And that's what they normally use to measure how much credit risk or how much, what's the quality of the loan per se. So when you look at used cars, because prices have been so high in the past, this ratio has gone significantly above 100, right? And if you look at the new car segment, you don't really have a problem per se there. And I'm sure if we were to look at this ratio maybe 5, 6 years ago, before 20, maybe between 2015 to 2020, we would see that these ratios have been meaningfully lower. So this uh, this is a bit of a problem because it tells me that the people who have been taking loans, particularly at very high LTVs, they would probably have negative equity in their cars, especially as used car prices are coming down. So that's a problem for two reasons. One is they have a high propensity to default on their loans because the asset that they are holding has little to no value, right? Negative equity means you need, once you pay off your loan, uh, negative equity means if you sell off the car, right, you still need to add more money to be able to pay off your loans, right? So put it in perspective. Let's say you have a $40,000 loan, you sell the car, the asset itself, and you get 25,000. And now to repay your loan, you have to pay $15,000 out of pocket to, extinguish the whole loan. So typically with, let's say, mortgages, if the house prices have been rising, you don't have that problem because you sell the house, let's say for 2 million, you pay back the loan of 1.5 million, then 500,000 is like the equity that you get to pocket. Here it's totally the opposite. And the whole reason is because the loans were taken at the wrong part of the cycle with very high LTVs. And I don't think they ever had a chance to go positive in terms of equity. But of course, auto owners don't really know about these things, so they only find out when they go and try to trade in their cars. The second reason why this is a problem is because a lot of new cars are financed with a used car. So people would drive a car for maybe a couple of years, then trade it in, and then use that money towards the purchase of a newer car. And I think this is going to put a lot of pressure on the new car segment because people don't have anything to trade in, right? You trade in and then there's no value in that you can put forward to your new car sales, to your new car purchase rather. So if you have any questions, feel free to unmute and ask and clarify if that's making sense or not making sense. So I suppose no questions so far, right? Okay, I'll move on. Um, this is another interesting graph, right? So this is telling us that the share of used vehicle originations with starting LTVs of 120% plus has more than doubled over the last 3 years from 27% to 50 to 54%. So in 2021, these outsized LTV loans were only 27% of all loans. And now they are basically the majority. So 54% is the majority. So when I look at this, it paints a bleak picture on the future of this industry, mainly as used car prices keep coming down, right? I mean, what you're basically saying is a lot of people hold cars that have I mean, if the car has zero equity, that's great. A lot of these would have negative equity by now. The situation is not that bad on new car financing, so it's still manageable. But the problem is more in terms of used vehicles. And just to summarize why this happened, you would remember during COVID they were not manufacturing a lot of new cars, so people were being forced to buy used vehicles, and that's basically what caused this whole mess, right? And also, I think there was a lot of loosening of credit standards. So when people were giving credit at that point in time, they were very lax with their requirements, and they onboarded a lot of people who, on today's date, would not be able to qualify for the same kind of loans. So, with all of that said, I also wanted to have a look at what's happening to delinquencies across different credit segments. So all this data is coming from TransUnion. They have a very good report that you can check online, very easy to understand and quite interesting in terms of, all the detail that they make available. So this is the 60-day plus delinquency rate, right? So 60 plus, so delinquency typically is measured at, go ahead, Bhavan, ask your question.
Yeah, one thing I'm not very clear here is the origination of higher loan to value.
Yeah,
When you give out loans, it should always start at 100, right? And then it
you
goes
would think
up
so.
because the used car value
Yeah.
coming down.
No, you would think so, but the problem is used car values are coming lower, right? So what happened is there's a bunch of things, right? So the buyers, the guy taking the auto loan is only concerned about the monthly repayment, that amount, right? So what a lot of these car dealerships were doing was, so of course interest rates were higher, car prices were higher, and then basically what they were doing is they were saying, okay, don't worry, we'll extend your loan to 7 years instead of 5, right? Just to reduce the car interest payments. So as you do this, right, uh, you're basically changing a lot of the dynamics when it comes to the time to equity, right? So you basically are not giving the guy any chance to ever get equity into their cars, right? And you're right, as the value of the car goes down, the LTV will also rise quite significantly, which is happening now, and I think this will happen a lot more. And basically, what we're saying here is if there is, let's say, an issue with employment or, you know, people feeling a bit more distressed, these delinquency rates could skyrocket meaningfully higher from here, right? This is the fuel for delinquency in the future, right? That's the whole reason I'm sharing this, because uh, and the reason why we see that originations are happening predominantly now in super prime, which is the highest credit scores, it's because a lot of these lenders have realized they have a big problem on their hands, right? So
Yeah,
this is unfolding quarter on quarter, and we are getting the data through the likes of CarMax, Ali Financial, these industry reports, and I think it's a disaster waiting to happen. It might happen in slow motion, and then it's more manageable. But if you have an issue with the job markets, I think this will be the catalyst to just make everything go sour. Is that clear?
yeah, clear.
Okay, so let's look at what the delinquency rate is doing across different credit segments. So keep in mind, we're looking at the 60-day and above delinquency rate. So these are people that are very likely to default on their loans. So delinquency is measured as 30-day, 60-day, 90 days, and above. And typically, if you're delinquent within the first 30 days, there is a possibility that the bank can negotiate with you to restructure your loan and find a solution around whatever problem you might be having that's preventing you from paying back your loans. But when you go 60 days and above, it probably means that there's not much that can be done now. It's definitely going to become a default. So delinquency is basically labeled as you missing your first interest payment, your first not interest payment but debt payment, right? And then it's basically counting the days from the first debt payment until now, right? So if you haven't been paying your loan for more than 60 days, there's a high possibility that you will be defaulting on the loan. And the problem in autos, again, coming back to these LTV values and so on, and negative equity, basically what that means is if the bank goes to these guys and say, look, I want to work with you, let's try to restructure, let's do something, the guy's going to be like, for what? I have negative equity in my car. There's no reason for me to pay back my loans. So I think I've been speaking about this for more than a year now, right, Bhavan? With my CarMax thesis and everything.
Yeah,
And it's not happening like in spectacular fashion, but it's unfolding, quarter on quarter. We can see these numbers creep up. Still manageable, but there's gonna be a day when this will just go significantly higher. And the other thing that doesn't get mentioned a lot because people don't know how to put all of this together is a lot of these car dealerships like CarMax, AutoNation, and a few others, they've started their own financing department now, right? Because banks have, you know, become a lot more stringent on underwriting requirements, and they are not accepting like everyone who walks into the dealership. Then the likes of CarMax and others of seeing this as an opportunity to create their own financing and by virtue of that, stimulate their own revenue for car sales. And that is basically what I see the problem that's gonna happen, right? It's like a hidden time bomb. So everyone's looking at the financing as, that's a new stream of revenue for CarMax, AutoNation, and all of this. Look, they're doing great. They are managing delinquency rates and all of that. But, delinquency rates only matter when they start to really matter, right? And we've seen that CarMax have been consistently increasing their loan provisions, and that's to reflect. And they keep talking about using AI. Yeah, it's like it's it's uh, it's bonkers, right? I mean, everything is just tied to the jobs market. If people lose their jobs, then they have zero incentives to keep repaying their debts, right? Especially with how things are, right? I don't think that's going to be much of an issue with mortgages because people still have equity. They might be still be able to exit the whole investment and maybe break even or make some money on top of it, unless there's like mass unemployment in the US, which I'm not seeing at the moment. But with autos, and especially the crisis in autos is more geared towards the lower income people, right? So we know that the lower income people are the most vulnerable, and they form a large part of whoever has been given these loans in the last few years. So they are the most vulnerable, and if there's any slowdown in the economy which results in job losses, they'll be the first one to feel the impact of it. So these reports are all there to give you an indication of what's out there in the public domain. Keep close to these reports. There will be a day when they start to matter a lot, right? And you'll see this all over Twitter, all over Bloomberg, and everyone's going to talk about it because it's going to matter. So when we look at the auto segment predominantly, we see a consistent increase, right, over the years. And my view is that we'll still see this increasing, and we just need to keep an eye on this because the market does not always like, for instance, if we see this number increase by less than what the market was expecting, this might even be bullish for some equities like Ali, like CarMax, and so on. But if we see a significant flaring up in these numbers, it's going to be very bearish for a lot of these names. Um, so moving on, I think this is also another interesting graph to see. Bhavan, I think we did a study with CarMax and the data that they provide, right? To in that PDF, you remember? Um, it's
Yeah.
like a prospectus for all the investors that buy their loans and so on. So this is confirming the same findings that we got on that report. In that the way to interpret this is if you look at these lines over here, these are predominantly 2018 to maybe 2021, right? And the way to interpret the x-axis is the number of months that the loan has been on the book. So the number of months since the person has bought the car, right? So for this segment, this exhibits relatively similar behavior in terms of delinquency rates, right? But when you look at the latest cohorts, basically 2022, 2023, and 2024 onwards, the starting point itself is much steeper. So this tells me that a lot of these loans that were given here were not underwritten properly. They were not stringent enough with requirements, and now we are seeing significantly higher delinquency rates from these later cohorts. Is that making sense to everyone?
Yes, it is.
No, sorry, could you repeat that, please,
Sure,
Kaushal?
sure. So, okay, I'll start off again. These ones, so pretend you don't see these three lines, right? These ones over here, they are basically 2018, 2019, 2020, and 2021 numbers, right? They all
Yeah,
exhibit relatively similar behavior in terms of delinquency rates after 60 days, right?
right. It's
So
becoming
this is
steeper
the,
now.
yeah, so let's put this in context. Let's say we have given 100 loans in each of these quarters, right? In each of these cohorts. Um, in these earlier cohorts, we would expect that by, let's say, the 40th month, that we probably would get a delinquency rate around, let's say, 7 to 9%, right? That's typical of the previous cohorts. However, if we look at the newer cohorts, which are 2022, 2023, and 2024 onwards, um, these exhibit a steeper delinquency rate right from the start, right? So, as an example, for the cohort in 2022, by month 40, you're probably looking at rates somewhere here, or maybe here, right? Like 15, 16, 17%, which is
Mhm.
much higher than what we've seen in the worst cohort in this band, right?
Yeah.
So, my whole
Um,
point is, as this develops, right, as we get more months on the book for these newer loans, the delinquency rates are proving to be much higher. And a lot of that has to do with poor underwriting conditions, people buying cars at elevated prices, people adding a lot of accessories to their cars and funding that through debt. So there's a lot of this playing out. And at the same time, the car prices are coming down. So people have negative equity. And as we can see, when you have negative equity, the propensity to become delinquent is much higher, right? We're still early in this whole thing. And as this progress, my expectation is that this is gonna be much higher. Probably the newer cohorts will be much lower because they become a lot more stringent in terms of their underwriting. But this cohort in itself has a lot of exposure, enough to make a lot of these dealerships suffer quite a bit economically. And this is in the midst of a jobs market that's holding up, right? So if we are to see further layoff as we go into the year, you can expect these graphs to just go much higher. So again, I'm painting a picture whereby there's a lot of fuel in the tank when it comes to delinquency within the auto segment, um, and you don't need a lot to spark that fuel. Maybe just a slight worsening in the jobs market, a bit of economic slowdown in general, and then you'll see these numbers go up much much more. Are we clear?
yes, thanks.
Okay. So this is another way to show the account delinquency rate above 60 days of delinquency. So that's how it's been ranging between 2009 and 2024. So we get these numbers. It's a year over year comparisons at the end of the quarter, um, and you can see, right, this number is now heading slightly higher above the 2009 peak. And I think we have not even seen the worst situation here. I think you can probably guess, right, that there's much worse to come. Any questions here? So maybe also a comment here. We saw like a drop over here during the COVID time because there was a lot of, first of all, there was the stimulus check that was given to everyone. There was also forbearance. So basically, people were being allowed to default on their loans without them being counted as delinquents. And, there's all of that was happening. And then eventually, as these measures were taken off, then we kind of normalize to whatever, the historical delinquency rates have been. So the reason I'm also looking at 60-day plus is because these are loans where it's very difficult to, restructure them and get them back to non-delinquent status. So these are going to be write-offs or defaults eventually. So another thing that people need to also consider, despite having real wage growth for a lot of US consumers, the cumulative payment growth has been much higher in terms of growth uh, when it comes to lower income consumers. So again, the lower income consumers are the most vulnerable. And the way to read this graph is basically that this is a percentile. So 10th being the the lowest income people, 20th being, slightly higher income, 50th even higher than these, 70th and 90th are the amongst the richest, right? Or the guys who earn the most, not necessarily the richest. So this is giving you an indication as to the level of stress that could be created if let's say people start losing their jobs. And I don't think I have the graph here. No, I don't have it here. But if you look at it's in the report though. If you look at there's a particular graph in terms of what's the percentage of the car repayments versus people's income. I think for the lower income segment, it's well over 15%. So that's a significant chunk of people's earnings. And if they start losing their jobs or maybe their hours get cut, there's going to be a lot of stress and there's a lot of fuel, like I said, to make this situation get so much worse for auto lenders and all these car dealerships. I think this is also quite evident, right? So the fastest growth of delinquencies have been happening in the lower segment, in the lower income segment of consumers. And that's not going to be a surprise, right? Because they are the most vulnerable. They are the ones who, probably thought they could afford something, and then eventually the economic situation changes, and then they realize this was a bad idea, and eventually they default on their loans or they become delinquent in this case. So I'll pause here. If you have any questions, feel free to unmute and ask your questions before we move on to other segments. No questions? So maybe what I've discussed here, how would that be relevant for the group? Let's maybe get a few thoughts from your end in terms of trade idea generation. So just to put things in perspective, everything I discuss is, let's say, 127% for trade idea generation, right? There's no other reason why I discuss anything. It's to give you more perspective, to show you the reports that are out there, what's the status of a particular market, and just to get you closer to the data, so you know how to move on from there and find actionable trade ideas. So, what do you think of what I've just showed you in terms of how that could benefit your trade idea generation process?
I could have a go at this. I guess I
Yeah.
would aim for um, car dealerships, but particularly used car dealerships where
Mm-hmm.
they have maybe like mostly cheaper cars and less luxury cars, because I
Yeah.
guess
Yeah. Yeah. Yeah.
the
Yeah.
lower income folks would focus more, would prefer to buy more like
Mm-hmm.
utility rather than
Yeah. So,
luxury.
so CarMax is a good name there because they pride themselves in, you know, selling used car prices at lower price points. So that's a very good candidate to look into.
Mm.
There are others, maybe they're not that big. I think I forgot to mention this, but this week, Car Guru, which is basically like an online portal that advertises cars for sales. So they don't hold the cars themselves for inventory or anything. They just pass on the lead to the car dealerships, right? So this week they warned about seeing reduced activity when it comes to these their portals, right? So that's telling me that the demand for cars is probably waning, and it's not necessarily yet reflected in a lot of these stocks out there. So there is potential for more pain. Uh, CarMax, we've shorted it a few times successfully, a few times maybe not so successfully. Um, if we look at the if we look at the share price itself, let's say you were to go in the market and now you're looking at CarMax as a potential short, right? So you can see it's been range bound, right? It tried to break above this range and then it fell back in, right? A large part of why we had this rally was because we were seeing some sort of stabilization in used car prices. Stabilization being maybe it's not falling as quickly as people were expecting. So, then people become a bit more bullish on the stock because, of course, if there's a recovery in the used car segment, then you'll see prices go much higher. But the price action seems to suggest that this has been invalidated now, and we're going to be heading back to probably this, let's say, 75 level, right? So between 83 and 75, there's probably a trade to be made, but only if you are convinced about the fundamentals worsening here. So you might sit it out and wait for earnings and see how the whole situation goes on. But there's also quite a bit of time between now and earnings, which will happen in I think 10th of April. So there's a lot of time between now and then. And you can spend that time learning about CarMax, doing your own research and figuring out if this is a short. So and predominantly, let's say we have this report that's coming out on Friday. I think I've got it here, right? Let's maybe carry on with this presentation, and then we can come back to CarMax. So next week we have quite a few things that we need to be on top of. One is the ISM manufacturing report. It's coming out on Monday. And then we've got the ISM services that comes out on Wednesday. And then finally on Friday, we have the non-farm payroll reports, right? So particularly if on Friday, this NFP report here, if it misses, I mean, we've already started seeing a little bit of worsening in the initial job losses data. So that in itself is not something that we will conclusively use to determine that the job market is weakening. And the non-farm payroll is basically what will aggregate all these weekly movements and give us a very good view on what's happening to the jobs market. So if we start seeing this indicating that the job market is weakening, that adds a lot more fuel to the trade of, let's say, shorting CarMax or shorting Ali, which is basically the biggest which is basically the bank with the biggest auto loan book, right? But of course, before we do that, we need to look through the company, make sure we understand the fundamentals, and then we pull the trigger. So that's the reason why I've discussed this little segment on auto loans, and just give you an idea of what the market is like and what the numbers are like. Because if we have a few catalysts that could unfold in this week, then that can make the trade a whole lot more actionable. Okay. Any questions here? Questions? I think what I'm also going to be looking out for on Monday and Wednesday. So the whole setup of the markets at the moment is that we are seeing a resurgence in ISM manufacturing. So after many months, we've seen a growth in new orders and the ISM index itself. So I'm looking to see whether that holds up, whether we get continuation of that trend, or whether we head back below 50. Because if we head back below 50, then that's going to give all these growth slowdown or recession fears a lot more room to run, right? And also, what's been holding back GDP for a large part of the last few years has been ISM services. So the ISM services has been in expansion territory for a long time, and now it's coming down. And the question is, do we see further contraction in ISM services? And if this goes below 50, right, at the same time, ISM manufacturing also goes below 50, then this will pave the way for, a significant sell-off in equities because that's not currently priced in at the moment, right? And it will just give a lot more credence to this whole growth slowdown thesis. So that's an important week coming. Just make sure you're prepared and you're looking out for these numbers and know what they mean. We also get leading indicators of inflation with both ISM reports. So what we've been seeing is a major expansion in prices for both manufacturing and services. So if that keeps happening, then I think the prospect for future inflation rising could be a lot higher. In terms of individual company earnings, there are many that are happening. I'm sure you can look at the earnings calendar and figure out which one you want to follow. But a few ones that I've highlighted here are mainly related to, two of them are related to the consumer spending. So Target, which happens on the 4th of March, and then Costco, which happens on the 6th of March. So we had Walmart reporting, I think it was earlier this week, where they missed on their guidance and they were not that bullish on consumer spending in the future. So I want to see whether Costco will also, feel the same way, whether we get the similar kind of feedback from Costco and Target, because the market will be eyeing these two as a proxy for what consumer spending might be in the future. So that's the reason why I've highlighted these two. And then we've got Broadcom, which is basically a big player in this whole AI telecommunications equipment, right? So with Nvidia earnings done now, from my perspective, it was a relatively good earnings report. They beat on all metrics and even raised guidance, but the stock still went down. So this tells me that expectations are like super stretched in stocks like Nvidia. A lot to do with this whole AI hype. Um, and if Broadcom comes in and they also don't necessarily hint at much faster, greater growth for their own business, I think this could spell trouble for a lot of these other companies that are in the same value chain, like Lumentum Holdings, like Celestica. There are a few others, Coherence as well. So that's the reason why I want to be on the lookout for these earnings. There are many more that I'll be following, but these are the three that I've highlighted for now. Do we have any further questions before we get into the price action analysis? Not really. So maybe I have a question for you. So what was your view of this week's price action? What did you notice? What did you take away from how the market traded? Go for it, Bhavan.
It was bearish. We saw
Okay.
the Magnificent Seven going down, the housing
Mm-hmm.
index, XHB also. I think I was noticing was going down quite a bit. I guess
Mm-hmm.
every pop-up would make it would result in a further fall ahead. I guess the Nvidia earnings was like a big day where,
Yeah.
I think it opened at 3% up or something and it ended, I can't remember, like 8% down or something like
Yeah.
that.
Yeah, so
So
it before earnings, I think it was trading at 133. Then in pre in pre-market it was up quite a bit, opened quite a bit up, and then basically just gave away all the gains. And now I think it's trading at maybe 126. Let's just quickly see. 125. Yeah. So very volatile for a stock like this. Yeah.
mhm, mhm.
And you can see
Also,
it's a constant tussle between bulls and bears, right?
yeah, and it seems to, I mean, not right, just right now on your chart, it seems to be touching the 200 moving
Yeah.
average.
Yeah.
So,
Yeah. So
uh,
it touched it, went below, and then managed to close above it. So still
but
technically above the red line, but
yeah.
it's probably in a weaker position now than before.
Mhm.
And it might just be selling off because people are deleveraging, right? We know that the whole world is invested in Nvidia. So, Nvidia is also part of the Magnificent Seven. So, Nvidia, Tesla, Facebook, Microsoft, Google, which one have I missed now? Uh, Apple, right? I think that's
Am-
seven in total now. These are
Amazon.
the components of the Magnificent Seven, right? And they've been selling off in the last 2 weeks quite a bit. And typically you don't see these stocks sell off that much, right? The last time we saw like such a prolonged sell-off was over here, right? When there was this whole carry trade unwind. And from my perspective, this is probably a reoccurrence of what was happening here. So the yen was strengthening, and then this goes a sell-off in these stocks because a lot of these stocks are owned by people who have been involved in this carry trade. And I think it's a big event if you see the Magnificent Seven selling off, because that's telling you a lot about how the market is perceiving the economy going into the future. And I think that's not something to be dismissed, right? What else did we notice about the market? Bhavan, did you want to say something?
Yeah, I think it was something along the same lines. It was a bearish move throughout the week, and then on
Hmm.
Friday we saw a bit of an uptick.
Yeah.
And I think it was the PCE reports were giving a bit of leg for the bulls to
Yeah,
come
it gave
out.
a bit of relief, I think, in terms of people who are thinking that inflation is out of control.
Yeah,
Certainly. Um, I think, what was I thinking? There's one more thing that I was thinking of. I cannot remember now. Um, what I found quite strange was that the market basically did not really react one way or the other with this whole Zelensky meeting. So it's almost like the US stock market doesn't really care about the outcome of that negotiation. Um, to a
true.
large extent, that makes sense because the the market has already adapted to that situation. It's been 3 years now, right? And doesn't really want to bet which way this will go because it doesn't have much of an influence at the moment for companies in the US.
Hmm.
So I think there was also this guy Bennett, right, who's the head of the Treasury. So he came out and he started speaking about one of the indicators he has on his end. Yeah, he was saying that one of the indicators he watches every day is the US 10-year yield, and he wants it to go lower. So that's a big statement. And at the same time, he said, we will. he knows that the housing market is in freeze mode, and that he expects the market to unfreeze in the next few weeks. So I don't know what that means. Does it mean that Trump will come with policies that will be friendly towards housing, or that he expects the US 10-year yield to go much lower? And by virtue of that, this will be stimulative towards mortgages and so on. This is a little bit confusing, or even uh, what's the word? This is basically where you don't know what to make of it, right? Because these are political statements, and when you look at the fundamentals, they are worsening like never before. And you're like, what should I bet on? That the politician's word will save and heal everything, or that the fundamentals and the business cycle will be what it will be, and equities will reflect these at the end of the day. There's another thing that is not getting talked about a lot. This whole thing of Trump wanting to abolish income tax. So if he does that, this is going to be massively stimulative to the US consumer. And that's going to change everything in markets, right? So as of now, it's not clear whether he will be able to do that and whether he'll get the right support for this whole bill to be passed. But if he does that, uh, and he manages to get everything through, I think you can expect this to be a little bit like helicopter money, right? People suddenly waking up and finding extra few $1,000s in their pockets. And the first thing they'll do is just spend it in the economy. Um, Now the problem comes with, if he stops collecting income tax and he wants to reduce corporate tax further, where is the US going to get its income, right? He seems to believe it's going to come from tariffs. I'm not so sure. Um, Tariffs, from my perspective, is another form of tax, right? It's basically a tax that is paid by people who want to buy imported goods, right? Um, so you're giving away, you're kind of abolishing income tax and now making the tax contribution a lot more, uh, what's the word, targeted towards people who are importing things from China, Mexico, Canada, and so on, right? So this is, I'm not saying how all of this ends up as a proper cohesive proposal that, actually works in reality. Uh, I think, I think I've said this a few times this week. Um, I don't know if I should say this publicly, but I think Trump is playing with fire in many respects, with his way of dealing with the Middle East, with his way of dealing with the Ukraine-Russian situation. I think he's already lost Europe. I don't think Trump is closer to Europe than he was, let's say, 1, 2 months ago. He's getting further from them. His vice president is certainly making sure that there is a big divorce between US and Europe. Um, at least that's how I'm seeing it. Because if he says to Ukraine, look, we're not going to help you in any way, go do your own thing. You refuse to sign the deal, so now you're on your own. So will the EU step up with additional commitments for weapons and all of that to fight Russia? Maybe. And if the EU does that, they're going to do it with a very heavy heart and a lot of resentment towards the US, right? So you can expect that the US will not be a great ally or considered a great ally if that happens. Already you've seen a lot of these European bureaucrats tweet or make their statements after Friday. giving support to Zelensky. I think they want to make sure that, the war doesn't come onto their own front doors because Russia and Europe, they're all landlocked. So, if Ukraine falls, then, the next few victims could be within Europe itself. And also, I think these are mere bureaucrats. They just talk a lot and, do little in terms of action. The question is, where's the money going to come from? Is the EU population willing to make further sacrifices just to, support Ukraine? I don't know about this. So there's a lot of question marks here. And I think Donald Trump is probably, he's moving around recklessly and not necessarily thinking through a lot of these measures that he's taking. Um, the UK has been one of the biggest allies of the US for the longest time, right? Goes back to many decades ago. And that relationship has never been challenged, right? But now you see the reception that the UK Prime Minister was given, and, in public, just accusing him and his country of failing when it comes to freedom of speech. Whether that's true or not, to actually mention something like this in front of the whole world media, I think that's very insulting. And I don't know if they do these things after a lot of consideration, on purpose, or if it's just like, people who don't know how to deal with world matters, right? But all of that being said, it's paving the way towards a lot more confusion, a lot more conflict. And if I have to kind of get back to what's the source of truth, I would probably say look at the consumer sentiment survey. Look at how it's worsening. I think this is the source of truth because as we've seen, right, the large part of GDP, right? Uh, where was that? So the large part of GDP comes from here, consumer spending, not government, right? Government can increase. I mean, if government doubles, it goes to 1%, but consumer spending is like 2.7 roughly. So if the consumer spending slows down meaningfully from here, I think we have a problem on our hands. And markets have already started to sense that. And, the imposition of tariffs is basically asking the US consumers to pay another tax, which I don't think they will look at very kindly. Anyway, any further questions? Any further comments about the market? Anything you'd like to ask or add? Anything you've seen that maybe I haven't covered?
Nothing in particular, Roshan, but I think your mic has changed.
Again,
Yeah.
1 second.
Roshan, one question. You mentioned your views of Trump playing with fire, and we mentioned how, at the start of your statement, you mentioned how the abolishment of income tax could result in like a booming move within the markets. Um, if Trump's policies backfire, as you say, he might be playing with fire. What do you feel the impacts of what do you feel the downsides of all this could look like?
Um, just give me 1 second until my mic is
Oh, sure, sure.
fine. This is a bit of an issue. Okay, you can hear me properly now?
Yep.
Okay. So look, if it backfires, there's a lot at play here, right? I think we could go into a deep recession. If the US consumer spending, stops growing and people start feeling the impact of inflation. So I think in my last call I mentioned that we might be headed towards a stagflationary environment where you have low growth but inflation stays high. That's a very bad place for countries to be. I think if you go back in history, you would see that uh, a lot of regimes have fallen from high inflation and high inflation, stagflation, or whatever you want to call it, and he's going to become a lot less popular than what he is now. Um, I think the fallout is also on a geopolitical front, right? Because if he messes up anything between these negotiations, this war with Israel and Gaza can go on for much longer, right? Um, the war between Ukraine and Russia might keep going on, right? Of course, is it a weakening of the current situation? No. It's been going on for a number of years now, so it will just be status quo per se. But I think it's paving the way towards a lot more, the US being a lot more isolated and a lot more hated, if I can use that word. So US businesses might find it difficult to operate in places like Europe, whereby people start boycotting them and people stop doing business with them because they don't agree with the whole foreign policy that Donald Trump and his team are taking. So we could be staring at a very different world if, uh, at the end of the day, all of this backfires. And just coming back to the US, right? They are not in a position of surplus when it comes to their own balance sheet, right? They have a lot of debt. Um, and if they don't collect revenues while also at the same time maybe keep the spending up, the deficit will keep increasing. Sure, you have all these guys at the Doge, whatever team, who are cutting down on spending. Uh, how much can they do? I don't think they can do a lot to bring the US into from a deficit to a surplus position. Sure, they can crack down on a lot of bad practices, save a lot of money, lay off people in government and all, but that's not going to make a big change to the balance sheet situation of the US. And the more the US uh, gets into a position where it's on its own and being asked to fend for itself, the more it will lean towards defense spending. And also, the rest of the world will move towards defense spending. I think Europe is very likely to increase its share of GDP that's dedicated towards defense spending, right? Germany has already made that commitment. I think the rest of Europe will do the same. And we'll head into a world where a lot more money goes into defense spending, armies, weapons, instead of actually going towards, building solutions for society and making sure that the standard of living across the world is getting higher. That's the problem with war, right? It's basically writing off many years in terms of standard of living improvements. And I'm hopeful that we will not get to this extreme. I'm hopeful that as he fails, he'll realize he's failing, and then he will come back to his senses. Um, he's also not been known to be a rigid guy who will stick to his word or who will die on his sword, as they say. He's a guy that he will flip flop just to eventually get to an outcome that works, and he'll paint it in a way that he's again the hero. He's been the one who's been able to be the catalyst in everything. We don't really care, right? What we care about is to have a world where you know lots of things are not changing overnight. That's what we all care about. He's of course gonna gloat about all the things he does, and anything that doesn't work, he has always got scapegoats, right? Whether it will be a foreign leader, whether it will be his own guys who are working with him. he's not gonna shy away from throwing people under the bus. I hope that answers your question
Thank
partly,
you.
at least.
Yes, thank you.
Okay, let's head into this segment where we do a little bit of price action analysis. So what I've got here is the credit risk premium that's currently being priced into corporate bonds. So at the moment, we've seen that this credit risk premium has been going sideways, and it's probably been at a low when you look at the last 5 years. Yeah, I mean close to the lows, right? So the market is not expecting much in terms of companies becoming bankrupt or having big liquidity issues and so on. So that's kind of the setup at the moment. I mean, of course, you've seen this rise a little bit. Keep an eye on this. If this keeps going higher, then this is something we need to be a bit more careful about, because this going higher will cause the risk assets to sell off quite a bit. Now, moving on to maybe I want to do world equities as well. There's one thing I wanted to show you. So I wanted to go to, let's do FTSE, let's do DAX. The rest are relatively not important. I'm looking for India. Yeah. Maybe let's do China as well. So just want to hide this. Yeah. So I've got a few of these world indices here. So I've got the S&P 500, Nasdaq Composite. We don't really need that. FTSE 100, the DAX, the German DAX, and then the Sensex for India, and finally the Shanghai Composite, right? So the S&P 500, it's almost been sideways for like 6 months or something now, right? It's been going down the last few months, and now we're seeing a little bit of resurgence. We'll see whether that will last or not. And then in terms of the German DAX, that's been an outperformer, quite significant outperformer. A lot of equities in Europe have been doing well. I think this is probably the relative value play happening, whereby US equities are probably being deemed as expensive, and capital is probably rotating out and moving into European equities because, on a relative basis, they are deemed to be cheaper. Let's put it that way. The FTSE 100 at all-time highs for once. So it's rising, but very timidly. And as you can see, it's not been doing a lot over the last few months. It's just been grinding higher. The one that I wanted to show you was the Sensex from India. I think we discussed this last week, whereby we indicated that India is also seeing a little bit of headwinds ahead of itself. So from October onwards, we've seen the markets have peaked. Maybe I'll put it on a 3-year basis so you can see better. So the markets have peaked and have been in correction since then. I have to work out whether they are already in a bear market. Let's just quickly do that. So the peak of the market was, let's say, 86,000, and I don't think we're in bear market. Yeah, we're still a bit further. So if I were to do this, yeah. Yeah, so we're not in bear market territory yet, but we're kind of close. I think once we get towards 66, roughly 65,000, this region over here, we should get a lot more concerned about this, because then it means that the Indian stock market is officially in a bear market, right? which basically means that now instead of people being net buyers, they are net sellers of equities. And typically this would be because of fundamental reasons in the economy. So I think what's happened is we've seen a bit of slowdown with the consumer spending. And as you know, there's a lot of hype with Indian stock markets or Indian economy per se. And a lot of times for good reasons, because there's a lot of things happening there. But with that also comes a lot of volatility. So a lot of hype meets with a bit of reality check, and then people realize that, oh, by the way, it's not all rosy. And then they start making adjustments to their portfolios. And then finally, the Shanghai Composite. So this has been a difficult market, right? If you look, I think over the last 5 years, the Shanghai Composite has only returned 13%, which is very low for, a big stock market like the one in China. And the reasons there is because they're having a lot of issues with the economy. It's currently in a deflationary bust, and the government is doing everything it can to stimulate and try to get it out of this difficult situation. But these things are not solved overnight. And as you can see, uh, this index has barely moved, right? It's been trading sideways. And I don't think this is in dollar terms, but if you were to adjust it in dollar terms, I think it would even be flat to negative. So that's supposedly the second biggest economy in the world, right? And not necessarily doing the best. And then you have the US, which is the biggest, and still in a big bull market with a correction, of course, happening lately. But, what what I'm trying to share with you here is that it's not all rosy out there. European markets are getting bid up. The US is probably seeing a bit of outflows. So as we got into 2025, US equities were on paper quite expensive relative to others, but the whole theme of US exceptionalism was still, coming through. And from that perspective, there was still a reason to justify why you would overpay for a US equity. Um, I think with everything that's unfolding, that's probably reducing people's conviction on that particular aspect. Any questions here? Any comments? Okay, nothing. So let's look at the sector performance in the US now. On a weekly basis, if you were to look at this on Thursday, the numbers would be very different. But because of on Friday in the last hour, everything changed, which is quite drastic. But nonetheless, let's look at the performance on the weekly basis. So tech is having another week of being the biggest underperformer. I think that's probably 2 weeks in a row, or I don't remember if last week it was the last or penultimate. I don't remember. Anyway, it doesn't matter. What matters is it's a significant underperformer, right? So the S&P itself was down nearly 1%, while tech was down nearly 4%. Utilities came down 1.3%. So that's quite interesting, right? Because utilities have been outperforming last week, and that was predominantly as a risk-off move. So utilities now underperforming. Is it a reversal of that trade, or are people now feeling less confident about this whole AI theme or requirement of power and all of this? Um, I don't really know. I think it's a combination of the two. I think people are definitely tapering their expectations when it comes to AI, which I think is probably wrong because the capital is there to keep investing in that space, and you'll need the bare bones of the like electricity, like cooling. Besides all these semiconductors, you'll need the bare bone infrastructure. So utilities are going to be a significant gain or beneficiary from this whole move. But yeah, I mean, if you're along that theme, you're not going to go buy a utility. Maybe you'll buy an independent plant producer or something, but that's about it, right? In terms of outperformers, financials did really well. So this outperformance in financials has been going on for a number of weeks now. I think Bhavan would be very happy to see financials on top here because he's long Ryan, which has been doing relatively well. And then real estate has also been a big outperformer here. So consistent outperformer in financials and real estate. And real estate is going up mainly because the long-term rates are going down. So it's an inverse function, right? And then we've got healthcare, which is a third outperformer. So quite interesting here because there's a lot of names in healthcare that have sold off quite significantly, mainly in terms of pharmaceutical drugs manufacturers and a few others. So it's interesting to see healthcare being an outperformer. Maybe this is a theme I wanted to get into because if we keep having a risk-off move and capital goes to the defensive sector, I think there are quite a few names within healthcare that could easily go up 20-30% just by virtue of them being under the radar and maybe oversold from a lot of concerns about the new administration and so on. So it's probably for us to do our work here. Maybe how do we do this? We probably could open a new tab, and then we can get into the holdings here. Just get a sense of what has outperformed and what has underperformed, right? So on a monthly basis, the biotech companies have outperformed, and then it's been significant underperformance for anything to do with healthcare providers, services, equipment, life sciences tools, and so on. So the new administration is trying to bring a lot more transparency in terms of pricing. And of course, there's a lot of companies that thrive from the lack of transparency in terms of the agreements that hospitals have with drug manufacturers and so on, all the middlemen that are involved in between. So with the new administration potentially now wanting to crack on a lot of these, you know, middlemen or even the lack of transparency, or even giving people more choice in terms of cheaper alternatives, I think that's going to put a lot of pressure on these companies. In terms of the return on a monthly basis, I mean, we still have companies that are doing relatively well, right? So 20% and upwards. And then I suspect if you were to go, so a lot of these companies are involved in, so for instance, this company, it's involved in this GLP-1 drug. So this is basically to fight against or to help with weight loss. So you pop a pill and then the next day you're slim, right? It's becoming quite popular in the US, and now the new administration could potentially start cracking down on this because there are some nasty side effects too, and it's not something that should be taken very liberally as they are at the moment. So if you look at healthcare, there's a lot of companies and they do different things, from manufacturing drugs to being care providers to being medical equipment providers. So as an example, this company, Intuitive Surgical, it produces robots that help in surgery. So this is quite an interesting company. I've traded it a few times in the past. And then you've got companies that Uh, yeah, there are quite a few interesting names here. So you'll have companies that maybe produce the equipment like um, pacemakers, also things like syringes, IV fluids, and a few other things that you need as part of running a hospital. So, if you're interested, you can always look at it. So, what I wanted to mention was you also have a lot of companies that are health insurers that are involved in this space. So, these companies have been selling off quite a bit, predominantly because of the new administration. Um, so if you wanted to find something in the defensive space, start doing some work here. As an example, this Align technology. So what they do is they manufacture aligners. So this is basically for people. These are dental aligners, right? So you would get them custom made, and then you wear them for a certain amount of time. And the whole idea is that your teeth would be much better aligned. But it's also becoming quite popular lately because it's no longer like the traditional aligners that you'd have to wear and see your dentist every now and then for adjustments and so on. This one is like a plastic thing that it's custom made for your own teeth, and then you just wear it, and it's a lot more pleasant to the eye and all of these things, right? So pick one of these companies and then do some work and figure out if this could be a good long idea from here onwards. But just be careful of some of the regulatory risks that these companies are facing. And then just coming back to this, it was quite interesting to see industrials and materials also back up after underperforming last week. And finally, what we need to note is the consumer discretionary sector is still underperforming, not as badly as before, but still underperforming. And consumer staples are outperforming. So, consumer staples might be another area where you might go hunting for a long defensive idea. Um, that's a space where you can find a few companies to hide into as a long. Do we have any questions here? Okay. I'm just gonna probably finish off with the industries because I want to finish at 6, since I know a lot of you might be fasting and you probably need to break fast as well. So we'll finish off with the US industries. So in terms of industries, not much in terms of who are the serial underperformers. So once again, clean energy. It's not been doing well at all since Trump got elected. And generally, solar and clean energy have just been selling off, and it's not a space that investors like a lot. There's a lot of lawsuits, a lot of dodgy things happening with a lot of these companies. Quite interestingly, semiconductors was also amongst one of the significant underperformers. So that would have to do with Nvidia and its peers. So if Nvidia is down, then you can expect that everyone in the value chain will also be down, from the guy who designs the chips, the guy who provides the software for the chip, the guy who manufactures the instrument to measure things that are needed while manufacturing chips. So everyone in the value chain will be impacted equally. Um, and then in terms of outperformers, so insurance was number one. So Bowen is very happy to see this. Um, REITs, because the REITs are basically like an inverse function of interest rates. So as interest rates got a bit lower, that probably caused the valuation of REITs to go up. Within REITs, there's something that might be interesting with the office REIT space. So it's been a big, like it's been in a big bear market for a long time. But Trump has started hinting that he wants more people back into the office. And I think there might be a case to be made that if you find the right companies, you might have significant upside here. So find one where, the prospects for improving from here and improving on metrics like occupancy and so on is relatively high compared to its peers, and that can be a very easy long to have in this environment. Regional banks also keep doing quite strongly. Home builders ended the week positively, and that was thanks to the last hour on Friday. Otherwise, it was consistently down. Agriculture also selling off a bit. I think we've had Nutrien and Mosaic reporting this week or in the last 2 weeks, and these reports haven't been the most positive. So the recovery in agriculture is not yet happening. I think we'll have to wait a little bit more to see that happen a bit quicker. And then finally, another bad week for gold miners. So even if gold is at relatively, I think it's near all-time highs, if I'm not mistaken, the gold miners are not doing that well. So that's quite a story here, right? You would expect gold miners to thrive in such an environment, but they're not necessarily, moving significantly higher. So let's just take a look. So this underperformance is happening from them having been rising for a number of weeks, right? So it's basically correcting from here now. There's a lot of talk about, if this whole Russian-Ukrainian conflict gets resolved, so that would be bearish for gold, right? Because that also caused a lot of movement or activity within the gold sector. So with that resolved, I think people are saying it will be bearish for gold. There's also a lot of talk that maybe the gold in the Fort Knox for the US is not there. So if that happens, what does that mean for gold? Is it bullish or bearish? I don't really know. A lot of rumors, a lot of speculation. I think at the end of the day, we have to look at gold miners as companies that are always losing value, right? Because they are extracting the gold, selling it, and then their resources are getting depleted. So if you can find a gold miner where the costs are significantly out of control, and at the same time, maybe you have the gold price going sideways or going down small, like a little bit, what could happen is you get a good 10, 15, 20% sell off in that particular name. I would much rather want to do a single stock idea here as opposed to, shorting the whole index. And, once again, we're not seeing a lot of activity in oil. So oil and gas and oil services have kind of been sideways or even in a sell-off. And that's not going to change until we see the oil price break out significantly higher. I think finally, one thing to talk about, so software and internet stocks were also down in line with tech stocks. So that's telling us that there's a lot of pain in these stocks. Retail was also down, so that's painting a picture on consumer sentiment. So all in all, if you were to summarize all the discussions that we're having, it paints the picture for a market with a lot of dispersion, right? A lot of sectors, industries that are doing well, a lot of sectors, industries that are not doing well. And that's amazing for us as long short traders, right? Because it means that if we find a very good if we want to find ideas that are bullish, there are many sectors that provide these. If we want to find ideas that are bearish, there are also a lot of sectors that are providing these. And uh, the market is actually differentiating between the two. There are times in the bull market where everything goes up, and at that point, it's hard to be a short because uh, you buy something, it goes up 10%. You short something, it goes up 10% too. So the correlation there is just 1 to 1. But now we're not in that kind of an environment. We're in what I would call a high dispersion environment. So there are lots of opportunities out there, guys. Do your work, find these ideas, and let's talk about it in the Discord server. I'll open up for some questions. We've got 10 minutes to go. Okay, fire away your questions.
I was looking at, it's not a question, Roshan,
Go ahead.
barely a comment. I was looking at the Stripe annual report.
Okay.
So,
Are they
and they were,
are they
are they,
listed?
no, I don't think they are listed,
Okay.
but they have a lot of exposure to all this new AI companies that is coming out. So could give like some sort of indicators how the companies are doing. And
Okay.
there was some interesting comment saying like, like for the AR, the AI companies are reaching a higher, I think it's 5 million or something, AR much faster than the traditional software companies.
Yeah, that makes sense. Yeah.
Yeah, and then like they are also seeing a significant upside, like in terms of transaction and everything.
Mm-hmm.
So I was thinking like maybe that's a good place to see like like where the long ideas can come from in terms of
Yeah, I mean,
AI.
I think this whole AI software theme is a strong one. I think we've discussed a few in the Discord server. There are a few that I probably haven't discussed. But I've shared a list of a lot of software names where I believe, they might have significant room to grow with AI. Um, I think the way I see AI is as follows. It the models themselves are now just a commodity. So whether you have ChatGPT, XYZ version, no one cares, right? Whether it's DeepSeek, whether it's Claude or whatever model is out there. The model itself is just, all of them are basically converging and becoming commoditized, right? The real value is in the application layer. It's not in finding the next ChatGPT 6.0, whatever. I think the real value is in the application layer. And with every business, right, you always ask about the competitive advantage. Why is it that if it's becoming so much easier to write software and to build a business, why is it that I will still have an edge, right? That's the question you're always asking yourself. And the real moat for these companies is the data that they've got. So if you're training your models on publicly available data, you have no moat, right? Anyone else can just spin the same thing and basically replicate your business. If you're training your models and providing products based on your own unique customer data, that has tremendous value, right? Because no one else can replicate that. No one else can replicate your offerings. So I think guys like PayPal, a lot of these fintech companies, they have a lot of room from that perspective. They're not yet coming with anything that's conclusive and that creates serious revenue or strategic changes to the business. But I think that's where we'll see a lot more of this AI being deployed and being very accretive to the business. For instance, I was thinking Zoom would be one good candidate, uh, but they are not the best in terms of software providers. Um, I still think the fintech space might be quite a fertile one for finding companies like these. I also shared a list of companies broken down by industry. So, for instance, for insurance, there was a few. For construction industry, there were a few that I think can use AI quite significantly within their software offerings. So, if you go and research these companies, chances are you'll find one or two free names that are worth following and eventually deploying capital.
Yeah. Yes.
Um, because I mean, if you think about it, right, insurance it's basically the first digital product that ever existed, right? You could sell it on the basis of an Excel sheet, right? Like an insurance policy is basically a row in an Excel sheet. And you would have thought that this industry would be at the forefront of digital innovation because by and large its product is digital, right? Think about it.
Yeah.
Sure, it's printing the policy and sending to you, but it's a digital product. It can sell as many policies as it wants. It's not got inventory. You don't have to collect the product at a particular office, right? So you would have thought that this industry would be the first when it comes to innovation. And ironically, it's the last, and it will always remain like this because, the people involved within that industry are not the most innovative and don't have the incentives to be innovative as well. So uh, you could look at maybe InsurTech, a couple of names. I think Oscar is one of them that comes to mind. But that's more to do with no, that's more to do with health. Uh, there was one called Verisk, yeah, V-Risk Analytics. So this is used quite a bit in insurance, and as you can see, it had a massive earnings, and then it rallied on the basis of that earnings. So that looked to me like a proper 15% roughly move, right? So there are many of these companies that no one talks about, but these are companies that are using AI and on that basis are able to revamp their business model. There's also this one in construction, Procore. Um, I've looked at this one. I'm not too excited about it, but it's just to give you an idea of the whole universe that you could start watching, and eventually, when you feel the time is right, you start trading them. Any questions? We've got 2 more minutes.
Yeah, hi Roshan. Maybe a quick question on uh, like data center.
Mm-hmm.
What is your view going forward? Because I've seen Microsoft decreasing a bit of their investment in data center, and I just wanted to know, is it like a broad thing that you're seeing across the board?
I haven't really paid too much attention to that.
Mhm.
What I know is the likes of Meta are keeping their capex in investment or projection or budgets. They're keeping these on the rise.
Yeah,
I haven't paid attention to what Microsoft is doing, um, but like companies like Amazon, for instance, right? Their whole business is now AWS. The
yeah,
stuff you buy on Amazon does not really add much to the stock. If anything, I think it's like taking away from it. So, you know, um, I still think we'll need a lot more data centers. We'll need a lot more of these power cooling solutions. That's not going away. As I think the best time to enter is to when people start doubting this and you see a little bit of a sell-off, maybe linked to Nvidia or some related stocks. Um, but if you think this, the thesis is still sound and we're gonna have more data centers, we're gonna need more racks, we're gonna need more servers and all of this. I think that's a sound investment thesis. And I'm sure Microsoft would have given some clarifications as to why they are decreasing their budgets, right? The biggest problem is a lot of these big seven, minus Nvidia, the tech companies, they feel a bit like suckers, right? Because they're taking all their free cash flow and then giving that to Nvidia. This is basically what's happening, right? All the work that they do, all the money that they're making, they're just taking that and then giving that to Nvidia for GPUs. Uh, I think they feel a bit a bit bad about this because to justify these investments, they need to be able to get the returns in the future, right? And if the economy is not growing, so Facebook, for instance, it relies on ad spending. So if the economy is not growing, ad spending will also not grow. If it stagnates or if it grows at a lower rate, then it's not going to be able to get a better return on its investment. And they're making very big, bold bets, right? It's not like small bets that they're making. So Facebook is an interesting one. I think I quite like Mark Zuckerberg's strategy here. Although I must confess, I've never been a big fanboy of his. I think he's kind of won over me in the last few months with his strategic approach to AI. And again, that's my personal view. I think the ChatGPT guy, Sam Altman, is very poor on strategic thinking. So he's going to be losing out massively. His choice of strategy is very poor, and you can see that happening now, whereby he's giving access to a lot of his premium tools to at much lower price levels. So he had like one offer at $200, and now whatever you could get for $200 is now included in the $20 per month or whatever. And I think he's making a big mistake by not going open source. So and Meta is really like driving that into the whole AI world, right? It doesn't matter if their models are not the best or whatever. Eventually, they'll all be the same, right? There's not going to be any competitive differentiation from having a better model or not, right? They'll all converge, and eventually, I think what will happen is models will be the best in terms of specialty. So maybe Facebook's model would be the best in terms of video production or image production. Some other will be the best in terms of medical diagnostic. That's basically where it's going to go. At the moment, it's just trying to be the best at general knowledge, right? So you're trying to win the general knowledge quiz, and there's not much value in trying to be the best at this particular task. There's a lot of value in trying to be the best at a specific task and become so differentiated from the rest that they cannot catch up. Then you have a significant moat or competitive advantage. But if you're all good at copywriting, for instance, or answering stupid questions like how many R's are there in a strawberry or whatever nonsense, what value do you get out of this? At best, you get a chat buddy, right? If you feel lonely and you need someone to talk to, you can talk to ChatGPT. And that's how it's been, right? Amongst all this hype, fluff, basically it's a chat buddy, right? Now, Meta has made that available on WhatsApp, on Facebook Messenger. So everywhere you have a model to talk to. So you basically have, there's zero value, right? The value is in actually finding real use cases to solve real life problems.